In this video, I'm going to share the two Metaverse stocks that no one's really talking about. These two companies are fundamental to building out the Metaverse, and yet they remain relatively undervalued. So I think there's a strong argument for adding them to your watch list if you're bullish on the growth of the Metaverse. According to Emergent Research, the global Metaverse market is expected to grow at a staggering 43% compound annual growth rate and reach a value of $830 billion by 2028. Another estimate by PwC predicts the market size will reach $1.5 trillion by 2030. So given the explosive growth potential, a lot of investors are rushing to buy into any name with a foot in the door, but I would hold off on jumping on the bandwagon too quickly. Most articles and YouTube videos I've seen focus their attention on a few high-profile companies like Meta, formerly known as Facebook, Unity, Matterport, Roblox, and Nvidia. But the problem is these companies are already hyped up and for the most part overvalued. Here's their EV to sales ratio, and you can see that Meta has the lowest multiple, but the rest are above 30, which is really high generally speaking. The reason I'm using this measure is because 3 of the 5 don't even have positive earnings yet, so we can't use the more popular PE ratio or the EV to EBITDA to compare them. Now, while Meta is relatively cheap compared to these other companies, if we're talking about the race to build and operate a Metaverse, it has a lot of catching up to do, because these and a handful of other companies are already well ahead of the game with billions of dollars invested and hundreds of millions of active users already engaging in an early Metaverse platform. Companies like Epic Games have already shown the potential of a metaverse with Fortnite, an online multiplayer game, already having registered 350 million players as of this year. In the last 2 years, Fortnite hosted a virtual concert with Ariana Grande and Travis Scott, where users attended with digital avatars to share the experience with others, and it drew millions of more users compared to in-person shows just a year earlier. So yeah, this is just an early preview of how massive the opportunities will be. So the question is, what companies can you invest in now whose products and services are fundamental to the Metaverse and that are still undervalued? The first company that's flying under the radar is Akamai Technologies, ticker symbol AKAM. Akamai is a global leader of what is known as Edge Computing Infrastructure as a Service Platform, or IaaS, and is the company that invented the Content Delivery Network, or CDN. Simply put, without Edge Computing Infrastructure platforms, the Metaverse cannot exist. To understand why, you need to know the basics behind cloud computing and distributed networks. Network first started off with a single cluster of servers at a data center. As the network's users expanded numerically and geographically, users experienced slower response times from a single source, and if the connection failed, the user's out of luck. The solution was CDNs, which brought data servers closer to the users and distributed and decentralized the data so that the user had faster access to it and it was more reliable. If connection to one server fails, the user will be rerouted to another server. This is essentially what AWS, Azure, and other cloud computing services are. But CDNs were still reliant on the central data center for processing, and this was a problem for networks that needed to handle more functions and still maintain the speed the users expected. The solution to this problem is edge computing. These days, more and more applications and content require processing, not just the data. And this is going to be exponentially true of the Metaverse. Whereas CDN infrastructure was constructed using conventional servers to handle content, the edge network needs to be able to handle and process data from a variety of devices like mobile phones, Internet of Things, and eventually devices that connect to the Metaverse. So yeah, edge networks matter to the Metaverse because in order for it to work, you need to bring speed, reliability, and processing power closer to the users and all their devices. And this is where Akamai has a huge lead over its competitors in the scale, the distribution, and the functions it can bring to its customers. It owns over 300,000 servers in 135 countries with more than 300 trillion API requests last year alone. Many of the world's top brands like Roblox, Riot Games, Pokemon, Microsoft rely on Akamai for their business to operate faster and safely, and the company has expanded rapidly beyond the US over the last several years. And it also serves businesses and organizations in these 9 industries with a strong presence among video game publishers. But obviously, Akamai isn't the only player in the edge networking business. Akamai has 2 other competitors in the edge computing space, Fastly and Cloudflare. Fastly and Cloudflare are the younger, faster growing companies, while Akamai is the established player in the industry. You can see that based on the valuations, Akamai has a much more reasonable multiple in every measure compared to its younger rivals. In fact, Cloudflare's EV to sales ratio is 5 times Tesla's valuation, so it's extremely overpriced. Another way to look at it is the ratio of EV to next 12 months of revenue. And when we compare a group of high growth SaaS companies by that measure, Cloudflare ranks as the most expensive, nearly twice as much as Unity. Now, Cloudflare's revenue is growing at an incredible clip at nearly 50% over the last 6 quarters, and it has the biggest profit margin of the 3, but has yet to produce positive earnings. So yeah, I personally wouldn't touch Cloudflare until the valuations come down. So at the moment, I consider Akamai to be a better value. Now, if you want to take your chances and pay up for growth, then Fastly might be a better bet with a lower entry point than Cloudflare. While it also remains unprofitable, its valuation has come down considerably from earlier this year when its EV to sales ratio was closer to 40. This is because back in June, Fastly had a massive technical glitch that took down Amazon, Reddit, a bunch of really popular news publishers, as well as the UK government website. While its customers have slowly returned and the impact to its long-term growth should be temporary, my take is that investor sentiment to its growth projections is a bit lackluster. But it may be a chance for you to get in on a fast-growing company while its valuation is subdued. Before moving to the next company, if you're getting any value from this video, I would really appreciate it if you hit that like button. And if you have at least a penny to deposit, Webull is giving away 2 free stocks worth up to $2,300 when you open an account and make a deposit of any amount. Webull is a trading app that is commission-free, no minimum deposits, there is no cost to use the basic service. So don't wait, claim your free stocks now by using the link in the description. The next company I want to talk about is Qualcomm, ticker symbol QCOM. But before we dive into this one, we need to step back and understand the landscape of the semiconductor industry and how this company fits into it as the industry pivots towards the metaverse. Of the 5 companies I mentioned earlier, NVIDIA had the most mentions because just like Akamai, it has to do with the metaverse infrastructure. Someone has to build out the physical infrastructure for companies like Roblox, Meta, and other software companies to create and operate their virtual content. At the heart of all this has to be cutting-edge chip processors that are in demand from not just NVIDIA, but AMD as well. These are the 2 hottest chip makers on the market right now and are likely to be battling each other for years to come as the metaverse demands huge investments in data centers and edge computing. But these companies are far from being cheap, with forward EV to EBITDA multiples of 70 and 42. Both companies' top-line revenue have grown at a staggering rate over the last 3 and 5 years, and the most recent year-over-year growth was an incredible 68 and 72%. And you can also see here their profit margins are really strong at 64 and 47%. The bottom line is, with results like this, it's not surprising both stocks have been on a tear recently, with NVIDIA up nearly 125% for the year and AMD up around 64%. But if you're looking to invest in semiconductors to get a piece of the metaverse market, the run-up of the price of these companies should make you nervous. Jumping onto the bandwagon at such high valuations should make you pause. Instead, I recommend taking a look at Qualcomm because its valuation is much more reasonable, and I think investors are overlooking a vital chip maker that is critical to making the metaverse work, which are the end user devices. If you aren't familiar with Qualcomm, the company's been around since 1985 and holds a vast amount of patents in wireless technology from which it receives royalties. It is also heavily involved in 5G, Wi-Fi, and AI technologies, the chipsets, software, tools, and services used to build end-user products across many different applications like automotives, wearables, and XR and VR and AR. And by the way, XR refers to real and virtual environments generated by computer technology and wearables. So VR and AR are subsets of it, both of which are gateways into the metaverse. Now, when we compare the company's multiples to NVIDIA and AMD, it's clear that this company is a bargain with an EV to EBITDA multiple that is a fraction of the others. And while its revenue is not growing as fast as the other 2, they're still very impressive numbers, and it's positioning itself to be the lead chip maker in the XR device space. One last point here is that its profit margin sits right between NVIDIA and AMD. And more importantly, that's allowed its operations to be a cash-generating machine that will give it a lot of flexibility to pivot towards growth areas. There's two recent events that illustrate how Qualcomm is executing this pivot. Back in early November, AMD announced it had formed a partnership with Meta to help power its data centers using its third-generation EPYC chip processors. Then just days later, Qualcomm CEO Cristiano Amon announced that Meta had shipped 10 million units of its Oculus Quest 2 headset, which are powered by Qualcomm's latest Snapdragon XR2 platform. The headset debuted last September as the culmination of a long-term collaboration between Facebook and Qualcomm to create the most advanced and immersive VR gaming experience. My point is that the company has been already moving forward in creating products for the metaverse years ahead of AMD's announcement. While AMD and Nvidia are going to fight for years to get their chips into data centers, Qualcomm is already leading the race to get its chips into end-user devices. According to the company, the new chipset was purpose-built for XR, with big improvements to the CPU and GPU performance, better display resolution, 11 times the AI processing for more immersive experience, and other innovations. But this work with Meta is just one of many partnerships for Qualcomm. Over the last 2 years, the company has partnered with both smartphone and telecom companies to deliver products that combine 5G, XR, and the metaverse at scale. It's collaborating with 15 different companies to deliver XR products powered by its Snapdragon 855 or 865 mobile platforms for the next generation of 5G-enabled immersive experiences. With all that being said, I'll leave you with this. Recently, the CEO made the case that Qualcomm will dominate chips for the new frontier of the Internet of Things, including the metaverse. He states that if you're going to spend time in the metaverse, Snapdragon is going to be your ticket, referring to the company's mobile app processor and modem platform. So there you have it, guys. If you got any value from this video, be sure to hit that like button and consider subscribing. Thanks for watching, and I'll see you guys next time.